Stop what you're doing right now. Put the silver charts down, close the Kitco tab, and stop refreshing those COMEX delivery reports. Because what I'm about to walk you through tonight has nothing to do with what silver did on Friday. It has everything to do with what is happening to your money at this exact moment, while you're sitting on your couch thinking the battle is still being fought somewhere on Wall Street. It isn't. The battle moved about 6 hours ago. It moved to the Chase ATM on your corner. It moved to the Bank of America branch 2 miles from your house with a sign on the door you haven't noticed yet. It moved inside the Wells Fargo app on your phone that's showing you a number, a balance, a digital promise from an institution that may not be able to honor that promise when the sun comes up Monday morning. This is not theater. This is not a dramatic hook to keep you watching. This is a liquidity event unfolding in real time a Saturday night in America. And the reason you don't know about it yet is because the people engineering it designed it to happen while you're not looking. Let me walk you through the crime scene. Friday, March 27th, 2026. Silver closed around $68.44 an ounce, after one of the most violent weeks precious metals have ever seen. Gold settled near $4,460. The gold to silver ratio tightened back towards 63-1. Those are the numbers CNBC flashed across your screen. Those are the figures Bloomberg printed. What they didn't print, what they will never print, is what happened underneath those numbers. In the options pits, in the clearing houses, in the margin call queues that started firing at 2:45 p.m. Eastern and kept firing until the cleaning crews shut off the lights on the trading floor. What happened Friday afternoon was a gamma flip, and I need you to understand this concept, because your financial survival on Monday morning may depend on it. Market makers, the institutions that sell you puts and calls, the ones running the sophisticated algorithmic risk models with all the Greek letter variables, those desks have been operating in negative gamma territory. When they flipped to positive gamma, every tick silver moved in the wrong direction, forced them to buy more metal to stay hedged. Buying more metal pushed silver higher, which forced them to buy even more, which pushed it higher still. It's a feedback loop, a self-reinforcing spiral buried inside a Bloomberg terminal. And by 4 p.m. Friday, estimated losses across the top 6 bullion bank derivative desks were somewhere in the range of $40 to $50 billion. Exposed, unrecoverable over a weekend, sitting on the books of institutions that are supposed to smile at you Monday morning while you deposit your paycheck. Now, let me be clear about something before we go further. The suits want me to tell you this is not financial advice. It isn't. It's a survival guide for people standing in a burning theater. Do your own research. Verify everything I say tonight, and verify it fast because you may not have until Monday. I'm just someone with a spreadsheet, an internet connection, and a habit of reading the COMEX warehouse reports that nobody on financial television has ever once shown on screen. These are the same trusted voices that called inflation transitory in 2021. The same ones who said Silicon Valley Bank was fine on a Thursday and watched it collapse on a Friday. The same ones who told you the banking system was rock solid in 2023, right before 3 regional banks disappeared in 11 days. Take everything I say tonight and check it yourself. If you're watching this on a Saturday night, if you clicked on this video while the rest of financial media is dark, while Bloomberg is running reruns and CNBC is airing a documentary about Warren Buffett's breakfast, then you already understand something important. The most dangerous moves in finance happen when the cameras are off. And right now, this information needs to travel as far as it possibly can. Hit the like button on this video, not for my ego, not to feed the algorithm's appetite, because in 2026, the algorithm is a gatekeeper, and the shadow ban on independent financial commentary is real and documented. Every like, every share, every click on that notification bell pushes this past the digital filters that would rather you watch that Muffet documentary than find out your ATM might not give you cash tomorrow. That like button is an act of financial self-defense. Now here's what's happening tonight. Since 4 p.m., I've been receiving messages from people across this country. Archive members, community members, people in different cities, all describing the same thing. ATMs going down. Not one machine, not two, networks. A member in Phoenix told me 3 Chase ATMs within a 2-mile radius, all displayed temporarily out of service, starting at 5 p.m. local time. A member in Charlotte reported that his Bank of America app now shows a daily withdrawal limit of $300. Yesterday, it was $500. He received no notification, no email, the number simply changed. A member in suburban Chicago tried to pull $800 from her Wells Fargo ATM at 6:30 p.m. The machine handed her $200, then displayed daily limit reached. She's been pulling $800 from that exact machine every Friday for 2 years. Something changed today, while the markets were closed, while the trading floors were empty, while bank executives were on the phone with their compliance departments figuring out how to make it to Monday. I know what the skeptics will say. ATMs go offline all the time. Networks have maintenance windows. This is normal. And in normal times, I'd agree with you. A handful of ATMs going dark on a Saturday would be a maintenance ticket. But these are not normal times. These are times when COMEX registered silver inventory has fallen below 90 million ounces. Let me say that number again. 88.191 million ounces. That is a 32% drop in 4 months. Total COMEX silver inventory, registered plus eligible, has cratered from 532 million ounces in October 2025 to 366 million ounces as of late February. That's a 31% drawdown in the deliverable supply that underpins the entire paper silver market. The coverage ratio, the percentage of outstanding paper claims that could actually be satisfied with registered inventory, is sitting at 13.4%. That's stress territory, historically rare, associated with delivery squeezes and force majeure events. Paper leverage is at 7.5x, meaning there are 7.5 paper claims for every ounce of deliverable metal in those vaults. And April 2026, first notice day, is 2 business days away, with 1,726 contracts, representing 8.6 million ounces, still open and demanding physical metal. This is not a normal market. This is a powder keg, and the banks that wrote derivatives against it just got incinerated on Friday afternoon. I track these kinds of systemic liquidity freezes and shadow bank runs so that you never get locked out of your own wealth when the system seizes up. If tonight's analysis helps you prepare for what Monday might bring, consider hitting the Super Thanks button below. It directly funds the data subscriptions and COMEX tracking tools that make this kind of after-hours emergency analysis possible, while the mainstream financial press sleeps. Let me now break down the actual mechanism. Let me show you in granular detail why ATMs going dark on a Saturday night is not a coincidence. It is a calculated survival move by institutions that became mathematically insolvent at 4 p.m. Friday. The foundation of this whole thing is fractional reserve banking. You've probably heard the term, but I need you to hear it differently tonight, because right now it's not an economics textbook concept. It's a promise made by an institution that just lost $50 billion in a single trading session. J.P. Morgan Chase, the largest bank in the United States, holds approximately $2.4 trillion in total deposits based on their last quarterly filing. Under the current zero reserve requirement, they are legally obligated to keep exactly zero of that in cash reserves for depositors. In practice, banks keep some physical cash on hand. ATM refills, teller drawers, branch operations. Industry estimates put that figure somewhere between 1% and 3% of total deposits. Let's be generous. Let's say Chase holds 3% of $2.4 trillion in physical cash. That's $72 billion. Sounds like a lot until you divide it by their 80 million retail customers. That's $900 per customer. That's it. $900 per customer in the best case estimate. The real number is probably $500, maybe $300. Think about what that means. If 10% of Chase customers tried to withdraw $2,000 on Monday morning, that's $16 billion in cash demand against maybe $72 billion available. If 20% try, you're at $32 billion, getting tight. If 30%, you're at $48 billion and starting to sweat. At 50%, you're looking at $80 billion in demand against a supply that simply doesn't exist in physical form anywhere in the system. And that's just Chase. Multiply that across Bank of America, Wells Fargo, Citigroup, US Bank, and you're staring at a banking system that collectively holds roughly $18 trillion in deposits, with maybe $200 to $400 billion in physical cash across all institutions combined. The ratio is approximately 50 to 1. $50 in digital promises for every single physical dollar bill in existence. That's not a banking system. That's a magic trick. And the magician dropped the curtain Friday afternoon. Now let me explain where it gets truly ugly. Those $40 to $50 billion in derivative losses from Friday's gamma flip don't disappear over the weekend. They hit the bank's Tier 1 capital ratios, the core measure of institutional financial strength, the buffer between solvency and insolvency. Under Basel III, which was updated to Basel IV in the 2025 regulatory cycle, banks are required to maintain minimum Tier 1 capital thresholds. When a bank absorbs a $50 billion hit in a single trading session, that ratio drops. When it falls below the regulatory minimum, the bank enters what's called prompt corrective action territory, a polite phrase that means regulators start whispering about receivership. The FDIC starts making phone calls. The Office of the Comptroller of the Currency starts pulling contingency plans. And the bank, desperate to avoid that fate, begins doing everything in its power to conserve cash. Everything, including limiting the amount of physical money that can walk out the door. This is the mechanism. This is why ATMs are going dark tonight. These institutions know that when markets open Monday morning, the story of Friday's derivative losses will spread. Social media will amplify it. Reddit will be flooded. Twitter will be wall-to-wall screenshots of portfolio damage and derivative exposure charts. And when that wave hits the public, a percentage of rational human beings will do exactly what rational human beings do when they suspect their bank might be insolvent. They'll go get their money. Not a check, not a wire. Physical cash, paper dollars they can hold in their hands. The thing the bank doesn't have. And the banks have already modeled this scenario. They've stress-tested it. And the internal playbook for a potential bank run starts with throttling ATM access on the weekend before the crisis goes public. Think about the elegance of it. Saturday night. Branches are closed. Customer service is skeletal. Financial media is dark. Nobody is writing stories. Nobody is asking questions. And inside that void, a bank's IT department pushes a software update that quietly drops maximum daily ATM withdrawals from 500 to 300. Or they take machines offline and attribute it to scheduled maintenance. By the time Monday morning arrives and branches open their doors, the bank has already reduced its cash bleed by hundreds of millions of dollars across its network. They bought themselves time. They bought themselves survival. They did it with your money. They did it by trapping your purchasing power inside a digital ledger while they figure out how to patch a hole that cannot be patched. Tell me in the comments, have you seen any out-of-service ATMs in your city this weekend? Have your withdrawal limits changed without any notification? Did you try to pull cash tonight and get a different number than you expected? I'm building a real-time map of this. Every data point from the community helps establish the scope. And if you've already moved assets into physical silver held outside the banking system, share that too. Tell me your premium. Tell me what your local coin dealer is charging over spot right now. because those premiums are the actual price of silver, not the $68 figure on the screen. That 68 is what a computer says. The real price is what you pay when you walk into a shop and try to buy an American Silver Eagle. And right now, those premiums are sending a very loud message. Stick with me here, because I want to walk you through history. 3 concrete examples that prove this is not conspiracy thinking. This is documented, established financial behavior. The weekend has been used as a weapon before, and understanding how it was used before tells you exactly what's happening tonight. First example, August 15th, 1971. Richard Nixon appeared on national television and told the American people that the United States was temporarily suspending the convertibility of the dollar into gold. Temporarily. 55 years later, that temporary suspension has never been lifted. But here's the detail they skip in school. Nixon chose a Sunday night deliberately. The Treasury and the Federal Reserve spent that entire preceding weekend coordinating the executive order, briefing allied central banks, and engineering the announcement to land when the public was completely powerless to respond. The markets were closed. You couldn't sell dollars. You couldn't buy gold. You couldn't run to your bank. By Monday morning, the rules had changed while you were asleep. Your purchasing power had been restructured in the dark. Sound familiar? Second example, September 13th and 14th, 2008. The Lehman Brothers weekend. Everyone on Wall Street knew Lehman was dying. Treasury Secretary Hank Paulson spent that entire weekend inside the New York Federal Reserve with the CEOs of every major bank trying to arrange a rescue. And while those men negotiated in a conference room, what was happening at the retail level? The Reserve Primary Fund, holding $785 million in Lehman commercial paper, was quietly preparing to announce that its shares had fallen below $1. That had never happened in the history of money market funds. The entire system that corporations and municipalities use to park cash was cracking apart. Over a weekend. By Monday morning, Lehman was bankrupt, AIG was next, the credit markets were seizing, and the cascade that became the Great Recession had already begun. All of it originated in a weekend where decisions were made in the dark. Third example, March 10th, 2023. Silicon Valley Bank. SVB announced a $1.8 billion loss on its bond portfolio and said it needed to raise capital. By Friday afternoon, $42 billion in withdrawal requests had been submitted in a single day. The bank couldn't honor them. It was mathematically impossible. Saturday, the FDIC seized it. Regulators worked through the weekend. By Sunday night, they announced a guarantee of all deposits, including those above the $250,000 FDIC limit. But here's what matters. Between Friday afternoon and Sunday night, depositors couldn't touch their money. Their accounts were visible. The numbers were right there on the screen. But they couldn't convert those numbers into physical cash. They couldn't wire. They couldn't spend. They were hostages of a digital ledger during the most critical 48 hours of the crisis. The weekend was the weapon. It has always been the weapon. And tonight, Saturday, March 28th, 2026, that weapon is being deployed again. Let me walk you through what Monday morning looks like. Not prediction, mathematical extrapolation from the data we've already covered. When branches open at 9 a.m., the first wave will be the prepared. The people who watch this video, the people who follow the COMEX reports and understand what a 32% drawdown in registered inventory means for the banks that wrote derivatives against that inventory. These people will walk in with their IDs, request $5,000, $10,000, $20,000 in cash, and the bank will stall them. Here's how that stall works. Under the Bank Secrecy Act, any cash transaction over $10,000 requires the bank to file a currency transaction report, a CTR, with FinCEN, the Financial Crimes Enforcement Network. Standard anti-money laundering procedure. But banks have learned that this requirement can function as a delay mechanism. Request 10,000 or more, and the teller needs to complete paperwork. A manager has to sign off. They may ask you the purpose of the withdrawal. They may tell you they don't have that much cash available and ask you to return tomorrow. They may offer you a cashier's check as a substitute. Every one of those responses is a legally permissible delay tactic designed to slow the physical cash leaving that building. It gets worse. If enough people show up simultaneously requesting large withdrawals, the bank can invoke a hold for verification on transactions above a certain threshold. They'll say they need to verify the source of the funds. They'll say there's a security flag on the account. They'll say compliance needs to review the transaction. And you'll stand in the lobby of your own bank being told that you can't access your own money, while behind the teller counter, staff are watching the vault reserves drain and mentally calculating how many more customers they can serve before the cash is gone. This is not a hypothetical scenario. This is what SVB depositors experienced in 2023. This is what Cypriot depositors experienced in 2013 when the government seized a percentage of every account over 100,000 euros to bail out the banking system. This is what Greek citizens experienced in 2015 when ATM withdrawals were capped at 60 euros per day, roughly $65, for 3 consecutive weeks, while the government negotiated with the ECB. 60 euros per day in a modern Western democracy, for 3 weeks. If you believe that cannot happen here, you have not been looking at the math. I'll be tracking national banking networks and every localized liquidity event throughout the entire weekend. I'll be active in the community tab and responding to member posts as updates come in. Subscribe to this channel with the bell turned on so you get the emergency alert the moment a major institution declares a withdrawal halt. And follow my secondary channel linked in the featured section below. If this main channel goes dark, if the algorithm buries this video, the secondary channel is your backup. We're coming at them from both directions. This archive doesn't sleep. Now let me open up the geopolitical layer, because this isn't just an American crisis. This is a global liquidity event with consequences that reach from the COMEX vaults in New York to the Shanghai Gold Exchange, to the Bank of England's vault deep under London. What's happening to silver right now is not a bubble. It's not speculative fever. It's a structural repricing of a metal the modern world cannot function without. Silver isn't just money. It isn't just something you stack in a safe. Silver is the most electrically conductive element on the periodic table. Every solar panel, every electric vehicle, every 5G antenna, every missile guidance system, every medical device, every semiconductor chip requires silver. Industrial demand for silver is currently running at approximately 1.2 billion ounces per year. Mining supply is approximately 820 million ounces. The annual deficit is over 300 million ounces, and it has been running for 6 consecutive years. That is not a temporary imbalance. That is structural exhaustion of a strategic resource. Now layer onto that the Shanghai Gold Exchange, the SGE, which has been trading silver at premiums significantly above the Western spot price. As recently as February, the SGE premium was approximately $10 per ounce above COMEX spot. A buyer in Shanghai was paying $10 more per ounce than a buyer in New York for the same metal. That arbitrage creates a gravitational pull that drains physical silver from Western vaults and ships it east. When the vault's empty, the paper price disconnects from the physical price, which is exactly what we're watching happen right now. COMEX says $68. Walk into a coin shop tonight, and the silver eagle in the case costs you $85, maybe $90, maybe $95, depending on your city. That gap, that premium, is the market telling you in plain language that the paper price is a fiction. It's a hologram projected by an algorithm that is running out of metal to back its promises. Here's where the BRICS angle connects to everything else. While American banks are quietly throttling ATM networks to conserve cash, the central banks of China, Russia, India, and Brazil, and the expanding coalition of BRICS-aligned nations are doing the exact opposite. They are accumulating physical gold and silver at a pace that has no modern precedent. The People's Bank of China has been purchasing gold for 18 consecutive months. The Reserve Bank of India added over 200 tons in 2025 alone. Russia's central bank has been building its gold position ever since the West froze $300 billion in Russian foreign reserves following the 2022 Ukraine invasion. Those nations looked at a financial architecture built on zero reserve requirements, rehypothecated derivatives, and digital IOUs, and they decided to build something different. The mBridge project, the BRICS settlement platform, the digital yuan cross-border payment system. These aren't proposals. They're operational. They're processing transactions right now, and they're backed to varying degrees by physical metal reserves. The message from the East is 4 words. If you can't hold it, you don't own it. Tonight, as ATMs go dark across America and withdrawal limits quietly shrink, that message lands with more weight than ever. Let me close with one more calculation. One more piece of hard data to tie this all together. The U.S. national debt currently stands at approximately $39 trillion. The M2 money supply, the total of all dollars in circulation, deposits, and liquid equivalents, is approximately $21.5 trillion. Divide the national debt by M2, and you get a ratio of 1.81. For every dollar of actual money in the system, the government owes $1.81. Now take that $39 trillion of debt and divide it by total U.S. gold reserves, officially 8,133.5 metric tons, or roughly 261.5 million troy ounces. The math gives you a gold backing price of approximately $149,000 per ounce. That is the price gold would need to reach to fully collateralize the national debt. Gold is currently trading at $4,430 per ounce. That means gold is priced at roughly 3% of its debt backing value, 3 cents on the dollar. The gold market is telling you one of 3 things. Either the price of gold is going up by a factor of 33, or the purchasing power of the dollar is going down by the same factor. Or, most likely, both are happening simultaneously. And at the historical gold to silver ratio of 15:1, the ratio codified in the U.S. Coinage Act of 1873, and maintained through most of monetary history, a gold price of $149,000 implies a silver price of approximately $9,933 per ounce. You can disagree with the timeline. You can debate the trajectory, but you cannot argue with the arithmetic. The numbers are what they are. The vaults hold what they hold. The derivatives are exposed. The ATMs are going dark. And the institutions that built this system are spending this Saturday night trying to survive until Monday. The question isn't whether the system is broken. The question is whether you've positioned yourself outside of it before the next branch opens its doors. If this video reached you tonight, share it with one person. One person who still thinks everything is fine. One person who hasn't checked their ATM limit this weekend. Because the information advantage is real. And right now, information moves faster than bank runs. Drop your location in the comments. Tell me what you're seeing on the ground. And I will be back with an update the moment anything changes. Stay alert. Stay liquid. Stay outside the system.